All right, let's dive into something that seems super complex on the outside, financing commercial real estate. I mean, we're talking about huge, expensive projects, but once you break it down, you'll see it's all built on a few core ideas, and we're going to unpack those right now.
So let's just start with a massive question, right? You see a brand new skyscraper scraping the clouds, or a giant shopping mall. How in the world does something like that get paid for? It's not like you just go to one bank and ask for a billion-dollar loan. The real answer is actually way more interesting.
You build something called a capital stack. I want you to think of it just like Legos. It's a stack of different blocks, and each block is a different kind of loan, a different type of money, all layered on top of each other to build the whole thing. If you can understand this stack, you're going to understand commercial real estate finance.
Now, just like with any building, you have to start with a solid foundation. And in the world of financing, that foundation has a name: senior debt.
Okay, so senior debt is almost always the biggest, most important piece of the puzzle. Why is it called senior? Well, it's because it gets treated like a senior. It's first in line for everything. If a deal goes south, this is the lender that gets paid back first, no questions asked. That makes their position the safest one in the entire stack.
And check out how this all connects. Because the senior lender gets the first claim on the rent checks coming in and the first claim on the building itself if it has to be sold, their risk is incredibly low. And because their risk is low, they can give the borrower the best deal. This is the cheapest money you can possibly borrow.
Okay, but what if that big, cheap loan isn't quite enough to get you to the finish line? This is where the next layer of our stack comes in, and it's called mezzanine debt. I mean, this happens all the time. Let's say your project costs $10 million. The senior lender looks at it and says, great, we'll give you $6 million. You're putting in $2 million of your own cash. Well, you're still $2 million short. So, how do you fill that gap?
You fill it with what's called mezzanine debt. The name itself is a hint. You know, like a mezzanine level in a theater that's between the main floor and the balcony. That's exactly what this debt does. It slots right in between that safe senior debt at the bottom and the owner's own money, their equity, at the top.
And this visual shows you the pecking order perfectly. The mezzanine lender, the one in the middle, they only get paid after the senior lender is paid in full. That automatically makes their loan a lot riskier, right? If the building's income drops a little, they might be the ones who miss a payment. And this brings us to the #1 rule of finance. Higher risk for the lender always means higher cost for the borrower. Because mezzanine debt is subordinate, it's second in line, the lender is taking a much bigger gamble. So to make that gamble worth it, they charge a much higher interest rate. It's a powerful tool to get a deal done, but that power definitely comes with a price tag.
All right, so we've covered how to stack up debt to fund a project that's already stable. But what if it's not stable yet? For that, you need a totally different kind of tool. This isn't about filling a gap in money, it's about crossing a gap in time.
So picture this. You find an amazing office building, but it's half empty. If you take that to a traditional senior lender, they're probably going to say, whoa, too risky. Come back and see us when the building is full and making money. So how do you buy the building and pay for the renovations to get it full in the first place?
You use a bridge loan, and it does exactly what the name implies. It's a short-term, flexible loan designed to be a bridge that gets you from point A, your risky, half-empty building, to point B, a stabilized, profitable property that can qualify for that cheaper, long-term loan.
So the journey usually looks something like this. First, you acquire the property that needs some work. Then, you use the more expensive bridge loan to fund all the improvements and get new tenants in the door. Once it's stabilized, it's profitable, it's humming along, you can go get a traditional loan to pay off that expensive bridge loan. The bridge has done its job.
So let's recap. We've just put 3 really powerful tools on the table: senior debt, mezzanine debt, and bridge loans. I want you to think of these as the absolute essentials in any serious real estate investor's toolkit.
And honestly, this is the most important thing to remember. It's not just about memorizing definitions. Real success in this game is about looking at a situation and strategically picking the right tool, or maybe the right combination of tools, to get the job done.
Let's put it all side by side one last time. Senior debt, that's your low-cost workhorse, your foundation. Mezzanine debt, that's your more expensive, specialized tool for filling a funding gap to unlock a deal. And a bridge loan, that's your flexible, temporary tool to get a project through a makeover.
At the end of the day, the people who really crush it in this industry are masters of this toolkit. They know exactly how to structure their capital stack to hit their targets without taking on foolish risks.
So now you get it. You understand the fundamental tools of the trade. But, knowing what a hammer and a saw are is one thing. Knowing how to actually build the house is another. The next big question is, how do you even analyze a deal to know which tools you're supposed to use? And that is a question for next time.